Welcome to the Deep Dive.
Great to be here.
So today, we've got BP's 2024 annual report in front of us. It's a hefty document.
It certainly is, packed with detail.
And our job, really, is to pull out the key stuff for you, the learner. Cut through all that data.
Yep. Focus on what's really relevant.
We want to understand their performance last year, 2024, and also the big strategic changes they announced early this year, 2025.
And how they're handling that whole energy transition thing.
Exactly.
Yeah.
While keeping an eye on the money and the operation side, too.
And just for anyone wanting the source, it's the BP Annual Report in Form -20F-2024.pdf. You can find it on our website, bp.com annual report or bp.com reporting center.
Right.
It really does cover everything financials, their strategy thinking, sustainability.
Yeah.
The lot.
So our mission today is to guide everyone through those main points. Highlight the important numbers, the big shifts.
And give a clear picture of where BP seems to be heading without getting totally lost in the weeds.
Okay, let's dive in. 2024 performance. Just looking at the scale first. What are we talking about?
Well, headcount jumped up quite a bit. Now 100,500 employees.
Wow, okay. But still operating in 61 countries, same as before.
Yeah, the global footprint stayed the same, country-wise.
And their core business, oil and gas production.
Upstream production, yeah, that ticked up slightly. 2.4 million barrels of oil equivalent per day.
Okay, and on the newer side, EVs.
EV charge points saw some real growth, over 39,000 now.
That feels significant.
It's definitely an area they're expanding. And even retail sites, the petrol stations, edged up slightly to 21,200.
So traditional business holding steady, maybe slightly up, while the EV side is clearly growing.
That's a good summary. The headcount increase probably reflects some of that growth investment, too.
But then we get to the financial performance, and it looks quite different.
Yeah, this is where the story shifts a bit.
Profit for BP shareholders. It plummeted, didn't it? Down to just $0.4 billion.
A huge drop from $15.2 billion the year before. Massive.
And their other main profit measure, underlying replacement cost profit.
Same story, really. Down significantly to $8.9 billion from $13.8 billion.
And remind us, that underlying figure, what does it represent?
It's basically their core operating profit. It tries to smooth out the noise, the fluctuations in oil prices within the quarter and other one-off accounting things. Gives a clearer view of the ongoing business.
So even with production slightly up, profits are way down. What drove that?
Several things, according to the report. Refining margins got squeezed. That's the gap between crude cost and what they sell petrol and diesel for.
Right.
They also got lower prices generally for their products, lower realizations. And their gas marketing and trading arm didn't perform as well.
Any offset?
Well, taxes were lower, which helped a bit, but not enough to counter those other pressures.
Okay. What about the operational side? How reliably were things running?
Bit of a mixed bag. Upstream plant reliability, so getting the oil and gas out, improved slightly to 95.2%. It's pretty good.
But refineries?
Refining availability actually dipped a bit, down to 94.3% from 96.1% the year before, so they weren't running quite as consistently.
And on the transition side, beyond EVs, any progress there?
Yeah, they highlighted growth in their strategic convenience sites, think fancy retail outlets, up to 2,950.
Okay.
And renewables reaching FID, that's the final investment decision, the point they commit to build.
Right, FID.
That increased to a net 8.2 gigawatts, mostly solar through Lightsource BP.
But it wasn't all smooth sailing because lifting costs went up.
Exactly. Their upstream unit production cost, how much it cost them to produce each barrel, rose to $6.17 per barrel equivalent.
So it's costing more to get the stuff out of the ground.
Yep. Which, combined with lower prices and squeezed refining margins, well, you can see why profit fell.
Definitely paints a picture. Is that rising cost a worry long term?
It's certainly something they'll be watching closely. Could be older fields needing more work, could be general inflation. Likely a mix. It highlights that tension between the traditional business economics and their future plans.
And lastly, on the 2024 snapshot, safety and sustainability.
Safety-wise, the number of Tier 1 and 2 process safety events, those are significant incidents, decreased slightly to 38.
That sounds positive.
It is, generally. But their operational greenhouse gas emissions actually increased, went up to 33.6 million tons of CO2 equivalent.
That seems counter to their net zero ambitions.
It does. They attributed it mainly to flaring issues at their Tango gas facility in Indonesia and some temporary operating modes.
Okay.
They also mentioned their measurement methods have improved, so they're capturing things more accurately now. But yeah, an increase is an increase. It shows the challenge.
Right. So 2024, a challenging year financially, rising costs, but some progress in transition areas, offset by an uptick in reported emissions.
That sums it up pretty well.
Okay, let's move on. Big news early this year was the leadership change. Murray Auchincloss confirmed as CEO, and this strategic reset announced in February 2025.
Yes, a significant moment for them.
The message seems to be about balancing today's energy needs with building the future system. What are the key shifts in practice?
Well, they're putting more emphasis on strengthening their existing oil and gas business. Seems like they see it being crucial for longer than maybe previously implied.
Understood.
They're also looking to expand in biogas and bioenergy things that can often use existing infrastructure.
Right.
And crucially, they're becoming more selective about hydrogen and wind projects, focusing on fewer, potentially higher return opportunities there.
So maybe pulling back a bit on some of the more frontier transition tech.
It seems that way, yes, a more focused approach.
And they talk about a focus downstream, too. What does that mean for their refineries and petrol stations?
It means concentrating investment and effort on their core refining and marketing hubs, the places where operations are tightly integrated. They're planning about $3 billion investment by 2027 to improve performance there.
Suggest maybe selling off some less central assets?
That could well be part of it, yeah.
Yeah.
Streamlining the portfolio.
Now, this point about disciplined investment in the transition. You mentioned being more selective, but it sounds like the overall level of investment is changing too.
It is, and quite significantly. This is a key takeaway.
How much are we talking?
They now expect to invest between $1.5 and $2.0 billion per year in their transition growth engines through 2027.
And how does that compare to before?
It's a big reduction. Previous guidance was significantly higher, maybe implying upwards of $8 billion a year by mid-decade. So yes, they are definitely tapping the brakes on the overall transition spending level.
Wow, that's a major adjustment. Focusing on returns, fewer bets.
Precisely. Fewer, higher returning opportunities is the mantra now.
And linked to this, they mentioned refining their sustainability aims. Does that mean dropping some targets?
It sounds more like focusing them. Prioritizing the sustainability goals that are most directly linked to their net zero ambition and the core business's long-term success. Getting more targeted.
Okay. The report also mentions their climate disclosures and assessing the strategy's resilience. They feel confident based on recent analysis.
Yes, they ran their strategy against various climate scenarios, including tough 1.5-degree pathways. Their conclusion, based on the February 2025 update, is that the strategy is resilient through this decade.
But with a health warning.
Absolutely. They explicitly state, and it's important, that long-term forecasting is inherently uncertain. So treat these scenario analyses with caution. They provide insight, but they aren't crystal balls.
Got it. Let's quickly revisit safety performance. You said overall events were down slightly, but any nuances?
Yeah, the really positive bit was the drop in Tier 1 events, the most serious ones, down to just 3 from 9. That's a big improvement.
Good.
But Tier 2 events, less severe but still notable, actually increased. So it's not a completely clean sheet. And remember that refinery availability dip we mentioned.
Okay. Now, this Paris consistency evaluation for big projects. What's the headline there?
Essentially, for any new project over $250 million, they check if it aligns with the Paris Agreement goals. They look at the financials, the expected returns, but also the emissions intensity.
And in 2024?
They approved 8 big ones, and they assessed all 8 as being consistent with Paris. They also noted most exceeded their internal profitability hurdles, and the upstream ones generally had lower than average expected emissions.
Can you give us examples of the kinds of projects getting the green light?
Sure. 2 key ones they highlighted. First, net zero Teesside Power in the UK, a joint venture with Equinor.
Ah, yes, the carbon capture project.
Exactly. A big gas-fired power station, but designed to capture up to 2 million tons of CO2 a year and store it offshore. Up to 742 megawatts of power.
A major bet on CCS technology.
Definitely. The second one was Lingen Green Hydrogen in Germany. This is their first wholly owned, large-scale green hydrogen plant.
Green hydrogen meaning?
Made using renewable electricity, in this case offshore wind. They expect it to produce around 11,000 tons a year from 2027.
So examples of transition investments, but fitting that more focused, potentially higher return strategy we discussed.
I think that's how they'd frame it, yes.
Okay, let's circle back to the financials again. We know profit was down, operating cash flow too, $27.3 BN versus $32 BN. What about the different business segments?
Right. They report across 3 segments now: gas and low-carbon energy, oil production and operations, and customers and products. The weaker underlying profit really stemmed from factors across those lower refining margins, weaker prices, less contribution from trading, offset partly by lower tax, as we said.
And the tax situation, you mentioned the effective rate jumped up massively to 82%.
Yeah, but that was heavily influenced by fair value accounting and other adjusting items. The underlying effective tax rate gives a slightly better operational picture.
And that was?
That also rose, but less dramatically, to 41% from 39%, mainly due to the geographic mix of where they earn their profits.
And looking forward?
They expect the underlying ETR for 2025 to be around 40%, but they do flag it's sensitive to energy prices and profit location. Tax is always complex in this sector.
No kidding. Any specific highlights from the oil production and operation side?
The main one was their U.S. onshore business, BPX Energy. It seems to be performing really well, especially in the Permian Basin.
How so?
They hit their 30-40% production growth target a year ahead of schedule in 2024. And they brought a new processing facility online there called Checkmate to support further growth.
So the traditional engine is still firing in some key areas.
Absolutely.
What about future mobility and EV charging? Despite the broader transition slowdown, are they still pushing ahead there?
It seems so, yeah. They signed a big deal with Simon Property Group, the mall owner, for up to 900 ultra-fast chargers across the U.S.
Wow, in shopping malls.
Yep. First sites opening early 2026, apparently. And another partnership with LAZ Parking for charging hubs in 20 U.S. cities.
And also targeting trucks?
Yes, they bought a major truck stop in the UK, Ashford International, specifically mentioning the need to support HGVs transitioning to electric. So charging infrastructure is still clearly a focus.
Okay. And bioenergy? Any movement there?
A couple of things. They launched their own brand of HVO that's hydrotreated vegetable oil, a renewable diesel called BP Bioenergy HVO in the UK and Netherlands.
So pushing into renewable fuels.
And working on the supply chain, too. They signed a 10-year deal for waste vegetable oil and are collaborating with Corteva on developing new types of feedstocks, still active in that space.
Let's talk emissions again, specifically methane. It's a big focus globally. What did BP report?
They rolled out a new, more comprehensive methane measurement approach in 2024 across their main upstream sites.
And the result? Based
Based on this new improved data, their reported methane intensity actually went up slightly to 0.07%, and total recorded methane emissions rose too to 46 kilotons.
So emissions went up, or is it just better measurement?
That's the key question. They attribute the rise mainly to specific operational issues, like flaring at Tangguh, that are now being captured more accurately. They even suggest that overall flaring emissions might actually be lower than previously estimated using older methods.
So the headline number is up, but it might be more about transparency and accuracy.
That seems to be the message, yes. More accurate data, even if it makes the numbers look worse initially.
Interesting nuance. And overall, greenhouse gases. Scope 1, 2, 3.
Scope 1, direct emissions, slightly up. Scope 2, from purchased energy, was up on a location basis, but down on a market basis, reflecting renewable energy buys. Overall energy use was up, but emissions relative to production were fairly stable.
Okay. How are they managing all these climate risks from a governance perspective?
They have processes, big investments, over $250 million, get specific climate review. There's a group sustainability committee with senior leaders overseeing strategy and risks. It met 4 times last year.
And what specific risks are they flagging?
The big ones are what you'd expect. Risk to the value of their hydrocarbon business, from policy changes, shifting consumer demand, market disruption, basically lower demand and prices for oil and gas.
Makes sense.
Also, rising compliance costs from things like carbon pricing, and then the physical risks impact of extreme weather on their sites, analyzed under different climate scenarios.
You mentioned scenario analysis before. How deep did they go with that?
Well, they try to identify the parts of their business most exposed to transition risks, financially speaking.
Like?
Then they model the impact of different drivers like carbon prices or EV uptake speed on those areas. It helps test the strategy's robustness.
Okay. Security is obviously huge for them too, physical and cyber.
Absolutely. They describe a threat-driven approach. They have a 247 intelligence hub monitoring everything from activism and unrest to terrorism and cyber threats.
And cyber specifically.
They acknowledge the growing threat from nation-states, hacktivists, etc., but they state their existing defenses have been effective so far in managing these evolving risks.
What about the just transition aspect, helping workers and communities adapt?
They state support for it, aligning with Paris Agreement goals like decent work. They mention efforts to reskill employees, detailed more in their separate sustainability report. They also highlight that workforce feedback was considered during the 2024 strategy discussions and engagement continues. The board is apparently keeping a close eye on company culture through the changes.
And other air pollutants, beyond greenhouse gases.
They monitor things like sulfur and nitrogen oxides. Reportedly, total emissions of those were down 9% in 2024 compared to 2023, so some improvement there.
Risk management is clearly woven through everything. What's the overarching framework?
Consistency is key. They aim for a common way to measure risk impact versus likelihood across the board. This helps prioritize resources and ensures risks are reported up the chain appropriately. It covers financial, strategic, and operational risks.
And managing financial risk specifically, price volatility.
Diversification helps. Plus their financial framework, stress testing, keeping a cash buffer, and constantly reviewing markets. They use derivatives too, but the report emphasizes the broader management approach.
What about risks from partners and contractors? They work with so many other companies.
Yeah, they acknowledge that. Varying control over partners and contractors brings legal and reputational risks. They stress the importance of setting and enforcing clear standards for everyone they work with.
Makes sense. Okay, let's shift to governance and the board itself. What were their big focus areas in 2024?
A lot of focus on that strategic review, obviously, and incorporating workforce feedback into those decisions. They also formally wrapped up a temporary committee on culture, folding its work into the main people and governance committee.
The report usually details board member skills too.
Yes, it outlines the experience of people like the chair, Helge Lund, and the senior independent director, Dame Amanda Blank, including their other board roles. It also mentions the company secretary and their role.
Were they out engaging with stakeholders?
Seems so. They mention a board visit to their tech centers in India and their first hybrid shareholder event outside the formal AGM. They say this engagement fed into that February 2025 strategy reset.
What about the audit committee? What were they looking at?
Overseeing the external auditor, Deloitte, is a key job checking their independence and effectiveness. They reviewed audit reports, both internal and external. They also oversaw the leadership team restructuring under the new CEO and looked at succession planning.
And board diversity. How are they doing against UK targets?
They report exceeding the targets. 55% women on the board, 2 senior roles held by women, and 3 directors from minority ethnic backgrounds. Senior management below the board also shows increasing diversity.
Remuneration pay always gets attention. Any changes there linked to the strategy reset?
Yes, the Remuneration Committee tweaked the metrics for the 2025 executive bonuses and long-term share awards. They want to align pay more closely with the new, more disciplined strategy. For example, replacing an earnings measure with adjusted free cash flow growth.
And for 2024, how did the bonuses turn out?
The formulaic outcome was quite low, 22.5% of the maximum possible. And importantly, they state no extra discretion was applied for the executive directors. The CEO and CFO salaries also stayed flat following their appointments.
Okay, back quickly to emissions reduction. Did they give examples of specific projects?
Yes, a few examples from 2024 adding up to about 0.42 million tons of CO2 equivalent reduction. Things like replacing steam systems at a refinery and projects at BPX Energy to centralize distribution and reduce flaring.
And low carbon energy progress. That 8.2 GW renewables FID figure. How did that come about?
Mainly growth through Lightsource BP, their big solar joint venture, and also bringing a solar pipeline called Cygnus to FID. They acknowledge the renewable sector faced challenges in 2024, but they still grew their committed pipeline.
Convenience and mobility. Castrol lubricants. Any highlights there?
Strong performance reported against their 2022 targets. Castrol signed a partnership with Audi for their Formula One entry and continued growth in those strategic convenience sites we mentioned.
The report also lists shareholdings for the non-exec directors.
Yes, standard practice. It shows how many shares each non-exec held as of February 2025 and whether they meet the company's shareholding guidelines.
And ensuring directors have enough time for BP, given other roles.
They state they regularly review directors' external commitments to make sure they can dedicate sufficient time to BP.
What about overall risk management and internal controls? Who's responsible?
Ultimately, the board is responsible. They require the CEO to operate robust systems, and they review these systems periodically. The audit committee plays a key role in overseeing reports on internal control and risk management effectiveness.
Let's touch on the audit itself. What were the key audit matters Deloitte focused on?
The big ones, typically for an oil and gas major, were potential impairment of their upstream assets, basically. Are they worth what BP says they are on the books?
Right.
Second, decommissioning provisions, the estimated cost of cleaning up wells and facilities at the end of their life. And third, the value of exploration assets, money spent looking for oil and gas that hasn't been found yet.
And what did the auditors do?
Lots of testing. They checked BP's internal controls, challenged management's assumptions and judgments, looked at the evidence supporting valuations and cost estimates. For example, on decommissioning, they look at cost trends, discount rates, timing assumptions.
Did climate change litigation come up?
Yes, they looked at provisions for litigation, including climate-related cases, and agreed with management's assessment that no specific provision was needed at that time based on current information.
What about the assumptions BP uses for things like discount rates and future oil prices?
They disclosed the discount rate used for impairment testing, 8% post-tax for oil and gas, and they show their oil and gas price assumptions for the short, medium, and long term. Interestingly, the long-term oil price assumption is lower than in previous years, reflecting expectations of falling demand.
That's a key input. Financial instruments, hedging, any major points.
They manage commodity price risk partly through derivatives. They note sensitivity to interest rate changes on their debt. They also manage credit risk from customers. There's a mention of an accounting mismatch related to some LNG contracts and the derivatives used to hedge them.
And hedge accounting more broadly.
They use it for some currency exposures. Details are in the notes, mainly around managing foreign exchange risk.
Share capital, any major changes? Buybacks.
They detail the shares in issue and treasury shares. They continued their share buyback program throughout 2024, reducing the number of shares outstanding.
Okay. Other comprehensive income, what flows through there?
Mainly things like currency translation effects from their international operations and adjustments related to pension plan valuations, stuff that doesn't hit the main profit and loss statement directly.
The report includes detailed breakdowns by region for oil and gas activity.
Yes, tables showing capitalized costs, reserves, production, and financial results split by geographic area, standard oil and gas reporting.
And that standardized measure of discounted future net cash flows.
That's a specific SEC requirement. It's an estimate of the future cash flows from proved reserves discounted back to present value using a standard 10% discount rate and year-end prices. The report shows how this value changed during the year due to production, price changes, new reserves, costs, etc.
Accounting standards, any significant judgments highlighted?
Yes, several key areas require significant judgment. Impairment testing, obviously. Estimating those decommissioning provisions, deciding whether exploration costs should stay capitalized or be written off. Depreciation policies also involve estimates of asset useful lives.
And fair value measurements, especially with market volatility.
That was an audit focus, too, particularly valuing commodity derivative contracts where markets have been choppy.
Risk of management overriding controls. Fraud risk.
Auditors always consider this. They looked at potential pressures related to executive pay or share buyback targets, but didn't identify specific high risks of material misstatement due to fraud from override.
Going concern, is BP confident it can continue operating?
Yes, the directors state they assess this and have a reasonable expectation that the company has adequate resources to continue for the foreseeable future, so they adopted the going concern basis for the accounts.
And the auditor's overall opinion?
Unqualified, meaning they believe the financial statements give a true and fair view and are properly prepared according to accounting standards.
Okay, you mentioned impairment and decommissioning as key audit matters. Can you give a bit more flavor on the audit work?
Sure. For impairment, auditors challenge the key assumptions BP used in their value and use calculations, things like future production profiles, commodity prices, costs, and that discount rate. They compared assumptions to external data where possible and performed sensitivity analysis. For decommissioning, they tested the underlying cost estimates, looked at quotes, checked the phasing of expected work, and again challenged the discount rates used to calculate the present value of those future costs. It's detailed work checking complex estimates.
Did any acquired companies get excluded from the internal control assessment?
Yes, they mentioned that BP Bioenergy and Lightsource B were excluded from management's assessment of internal controls over financial reporting in 2024 because they were acquired during the year. That's fairly standard practice.
The report also includes the full consolidated financial statements,
Yeah.
balance sheet, equity changes.
Yes, all the standard primary statements are there, comparing 2024 and 2023.
One point on asset life: does BP expect the energy transition to shorten the life of existing refineries or oil fields soon?
Interestingly, management states they don't expect the transition to significantly curtail the useful lives of their main existing upstream and refining assets within the next 12 years, based on their current plans.
How do they account for joint ventures?
Depends on the structure. Joint ventures where they share control are typically equity accounted. Joint operations where they have rights to specific assets and liabilities are proportionally consolidated.
Foreign currency translation. Standard stuff.
Pretty standard, yes. Translating results from entities with functional currencies other than the U.S. dollar presentation currency.
You mentioned judgment on exploration costs. That seems tricky.
It is. Deciding if costs for drilling exploration wells should stay on the balance sheet as an asset requires significant judgment about whether finding commercial quantities of oil or gas is likely. It's reviewed regularly.
Depreciation on other assets, buildings, equipment.
Mostly straight-line depreciation over estimated useful lives. Typical ranges are given for different asset types.
We talked about oil price assumptions. How did the 2024 ones compare to 2023?
The near-term assumptions weren't drastically different, reflecting market conditions. But as mentioned, the long-term Brent oil price assumption for 2024's assessment was lower than the one used in 2023, signaling that expectation of declining long-term demand. Gas price assumptions also adjusted.
What about financial assets? How do they assess potential losses?
They use a forward-looking expected credit loss model, considering potential future economic conditions when estimating possible defaults on receivables or counterparty failures.
Supplier financing, any judgment there?
Yes, classifying amounts owed under supplier financing arrangements, deciding if they are standard trade payables or should be treated more like debt, requires judgment based on the terms of the arrangement.
And provisions for restructuring. Layoffs.
They recognize a provision only when there's a detailed formal plan and they've communicated it, creating a valid expectation among those affected. Standard accounting for restructuring.
Decommissioning and environmental provisions, huge numbers. Lots of estimation.
Absolutely. Significant judgment is needed for estimating the future costs of dismantling facilities, plugging wells, and cleaning up sites, often decades in the future. Discount rates, inflation, technological changes all play a part.
How is revenue recognized? When they sell oil or petrol?
Generally, revenue is recognized when control of the goods or services transfers to the customer. For most product sales, this happens at a specific point in time, like when the product is delivered or loaded.
Did they sell any major businesses in 2024?
The report mentions proceeds from selling interests in Arches Energy, their remaining Alaska assets, and assets in Canada, part of that portfolio reshaping.
In inventory valuation, how do they handle fluctuating prices?
Trading inventories that aren't price risk managed get adjusted based on month-end market prices compared to their book value.
Dividend information. What was paid, what's planned.
They detail the dividends per share announced and paid during 2024, and they mention the dividend announced in early 2025 for payment in March. The policy aims for resilience at lower oil prices.
Goodwill, any impairments there?
No material goodwill impairment was recognized in 2024 or 2023. It's tested annually by comparing the carrying amount of business units to their estimated recoverable amount, usually based on discounted future cash flows.
Transactions with related parties, like joint ventures.
They state these are generally conducted at arm's length on normal commercial terms. Things like commodity sales and purchases with standard payment terms.
Can we get a breakdown of provisions? Decommissioning, legal?
Yes, the notes provide a table showing the movements in different provision categories: decommissioning, environmental cleanup, litigation, and also provisions related to emissions trading schemes.
Pension plans always complex. What are the key details?
They have large defined benefit, final salary plans, particularly in the UK and US, alongside defined contribution plans. The notes detail the key financial assumptions used to value the pension obligations: discount rates, inflation rates, mortality assumptions. They also show how changes in these assumptions impact the P&L and balance sheet.
Market risks summarized. Price, currency, interest rates.
Yes, the report discusses their exposure to these key market risks and outlines the strategies used to manage them, including diversification and use of financial instruments where appropriate.
Credit risk. From customers not paying.
Yes, risk of counterparties failing on payments for products sold, derivative contracts, or cash deposits. They manage this through credit limits, monitoring, and sometimes requiring collateral. They also disclose credit exposure related to guarantees they've issued.
What about off-balance sheet arrangements? Things not directly on the main balance sheet.
They disclose BP's share of debt and lease liabilities held by their equity-accounted entities, like joint ventures. They also list guarantees issued for third-party obligations and commitments for future capital spending in those JVs.
Is there a summary table of all their contractual obligations?
Yes, usually a table showing future payments required under contracts like debt agreements, leases, purchase obligations, capital commitments, etc., broken down by when they are due.
Any specifics on major operating areas like Trinidad and Tobago?
The report often includes sections detailing activities in key regions. For Trinidad, it would likely mention their interests in production licenses and the Atlantic LNG facility, including any restructuring efforts there.
How does BP track resources before they become proved reserves?
They categorize potential hydrocarbons from early exploration prospects through to contingent resources, discovered but not yet commercial, and finally to reserves, commercial and ready for development. There's a process for maturing resources along this chain.
Did their proved reserves go up or down in 2024?
Total proved hydrocarbon reserves actually decreased by 8% in 2024. Natural gas reserves decreased by 15%. This reflects production outpacing new additions and also the impact of disposals.
What about refining capacity? Are they planning changes?
The report lists their refineries and capacity. Notably, they announced in February 2025 their intention to sell the Gelsenkirchen refinery in Germany. They also completed the sale of the Aparef refinery in South Africa in December 2024. More portfolio reshaping.
Regulation seems incredibly complex for them. What areas does it cover?
Pretty much everything. Environmental protection, health and safety, licenses to operate, transportation, product specifications, taxes, competition law. They're subject to extensive laws and regs in all 61 countries.
For renewables, what kind of rights do they typically need?
Usually leases or licenses for the land or seabed where wind turbines or solar panels are located, plus generation licenses to produce and sell electricity.
Greenhouse gas reporting rules, are they getting stricter?
They mention complying with various reporting rules, like in the U.S. and elsewhere. They also note potential impacts from changing regulations, like the possibility of shifts in U.S. environmental policy or new rules emerging globally.
Anything specific, like the California truck rules?
Yes, they mention the California Advanced Clean Trucks program and similar initiatives, noting they could impact their fuel sales and profitability in the U.S. over time as demand shifts.
And in Europe, the Green Deal.
Big focus there. They discuss the European Green Deal and the Fit for 55 package, things like the EU Emissions Trading System, ETS, the new Carbon Border Adjustment Mechanism, CBAM, and renewable energy targets. All have potential impacts on their operations and markets.
What about the UK post-Brexit?
The UK has its own ETS now, launched in 2021, covering similar sectors to the EU one. BP's North Sea operations fall under it. There's also discussion of potential changes to environmental laws now the UK is outside the EU framework.
Another EU initiative, the CSDDD.
The Corporate Sustainability Due Diligence Directive. It requires large companies to conduct due diligence on human rights and environmental risks in their value chains and adopt Paris-aligned transition plans. Compliance deadline is approaching.
The Russia-Ukraine conflict must still have impacts.
They state they've stopped sales in Russia and comply with sanctions. Divesting their Rosneft shareholding is still restricted by Russia, as are dividend payments from it. But they say direct impacts outside the Rosneft holding haven't been material.
Related party transactions, anything beyond the JVs?
Mostly transactions with their significant joint ventures and associates, which are summarized in the accounts notes, usually stated as being arm's length.
What about tax implications for shareholders receiving dividends?
The report usually includes a brief section outlining potential UK and US tax considerations, but strongly advises shareholders to consult their own tax advisors as individual circumstances vary greatly.
Dividend policy, again, any mention of a scrip dividend?
Yes. Alongside the policy of a resilient dividend and using buybacks for excess cash, they mention the scrip dividend program. This allows shareholders to choose to receive new shares instead of cash dividends, though it's subject to board discretion each quarter.
Practical stuff for shareholders' share certificates? Voting.
Information on getting replacement certificates usually involves a fee. Voting at meetings is typically 1 vote per share on a poll versus 1 vote per shareholder on a show of hands, though polls are common now.
And for holders of American depository shares? ADSs. Any fees?
Yes, the depository bank, who manages the ADSs, charges fees for various services like distributing dividends, issuing shares, processing votes, etc. These are outlined.
BP uses specific net zero definitions. Can you clarify those?
Key ones are: Aim 1 is net zero operations, Scope 1 and 2 emissions, by 2050 or sooner. Aim 2 is net zero on the carbon in their upstream production, but they retired that aim in Feb 2025. Aim 3 is net zero life cycle emissions of the energy products they sell by 2050 or sooner, cutting the intensity by 50%. They define the baseline, 2019, and what's included.
And those non-IFRS measures, like underlying RC profit.
Yes, they explain why they use measures like underlying replacement cost profit, strips out inventory value changes and one-offs, and underlying operating expenditure. They reconcile them to the nearest equivalent IFRS measure, like reported profit or expenditure. Management finds them useful for tracking core performance.
Finally, report structure.
Yeah.
Any contact info.
The report references the Form 20F version filed with the U.S. SEC, which often contains more detail, and there's usually contact information for investor relations or corporate reporting for further queries.
Right, that covers a huge amount of ground.
Oh.
Thanks for walking us through that dense report.
No problem. It's a lot to digest.
So, key takeaways for the learner. You should now have a clearer sense of BP's 2024 performance, that big profit drop, rising costs, but also some growth areas.
And that strategic pivot announced early 2025. More focus, more disciplined, especially on transition spending, strengthening oil and gas while being more selective on renewables and hydrogen.
Plus, the ongoing focus on safety, emissions reporting becoming more sophisticated maybe, and the shareholder returns emphasis through dividends and buybacks.
Exactly. Those are the crucial elements.
What stood out as particularly intriguing or worth maybe digging into more?
For me, the details on net zero Teesside and Linden Green Hydrogen give concrete examples of the kind of transition projects they are pursuing now.
Good point. Real-world examples.
Also, the methane reporting story, how improved measurement changes the numbers, that highlights how environmental data itself is evolving.
Yeah, that was interesting.
And maybe exploring their long-term oil price assumptions further, or the details of their climate scenario testing, plus the impact of things like the UK windfall tax, the energy profits levy.
Lots to potentially explore further. Okay, final provocative thought for our listeners to chew on.
Considering BP's revised, more cautious investment plans for the energy transition, alongside their clear statements about the continued importance of oil and gas, what do you think is the single biggest challenge they'll face in actually balancing today's energy demands with those long-term sustainability goals? And how might trying to strike that balance ultimately impact their financial performance and their role in the future energy system?
That's the multi-billion-dollar question, isn't it? Something to ponder. Thanks for that deep dive.
My pleasure.
Wondering how we quickly synthesize info for this podcast? We use AI. You too can boost your productivity with AI thanks to our sponsor, brainybeapp.com. Get instant answers and insights using top AI models like Google's Gemini, Claude 3, and the latest from ChatGPT. Stuck on a tough calculus problem? Snap a picture for an instant answer from BrainyBee. Need a deeper understanding? Ask BrainyBee for easy step-by-step explanation effortlessly. No subscriptions. AI for business, AI for fun. Skip the subscriptions. BrainyBee is number one.